Why is the smart money fleeing the very places you go to get healthy, while simultaneously pouring billions into laboratories you have never heard of? While the average retail investor is panicking over a 30% drop in gym stocks, the world's most sophisticated family offices are quietly staging a coup in the biotech sector. We are witnessing a fundamental split in reality, where the traditional forest of healthcare is being struck by lightning, yet the soil beneath is richer than it has ever been in human history. Hello, this is Warm Insight. Today, we are going to talk about the massive reallocation of global capital into the health sector and the hidden frontiers of investment that most people are completely overlooking. Leaving a like and subscribing is a huge help to us. To understand why the healthcare market is currently behaving like a bifurcated beast, we first have to look at the sheer volatility of the consumer health sector. Look at Planet Fitness. A 30% plunge in stock value is not just a bad quarter. It is a signal of a shifting tide in how the masses interact with wellness. But while the headline-driven herd is running for the exits, private capital is aggressively re-engaging with biotech and digital solutions. This is not a coincidence. It is a strategic pivot. To truly grasp the weight of this market, volatility versus the surge in innovation, we must look at the historical parallel of the 1920s economic transition. In the years leading up to the Great Depression, the world saw a massive expansion in consumer-facing industries. People were buying radios, cars, and appliances on credit, much like the recent explosion in low-cost gym memberships and basic wellness subscriptions. It felt like a permanent plateau of prosperity. However, underneath that consumer froth, the real industrial power was shifting toward chemical engineering and aviation technology. When the consumer bubble burst, the companies that survived and eventually defined the next 50 years were not the ones selling the most gadgets to the public, but the ones building the foundational infrastructure of the modern age. Today, the gym chains and traditional health services are the consumer gadgets of the 1920s. They are sensitive to every whim of the economy and every shift in pricing strategy. Meanwhile, the biotech startups being funded today are the chemical engineers of a century ago. They are building the fundamental tools for human survival. History shows us that during times of high volatility, the masses focus on the crumbling storefronts, while the titans focus on the blueprints of the new factories. The divergence we see today between the plunging stock of a gym chain and the rising investment in rare disease research is a mirror image of the shift from the superficial, roaring 20s to the hardcore industrial innovation that followed. This reaction by the herd is rooted deeply in our evolutionary psychology. Humans are biologically programmed to prioritize immediate, visible threats over abstract long-term opportunities. This is known as the availability heuristic. When a well-known brand like Planet Fitness cuts its guidance, it is a visible, tangible event that triggers our fight-or-flight response. We see the red numbers, we hear the negative news, and our brains treat it like a predator in the tall grass. On the other hand, the silent flow of billions of dollars into a family office's venture into AI-driven pharmaceutical manufacturing is abstract. It is invisible. It requires high-level cognitive processing to understand, because our ancestors survived by noticing the lightning strike, rather than the slow growth of a new species of tree. We are naturally inclined to obsess over market crashes, while ignoring the slow-motion revolution of innovation. We suffer from a collective myopia that forces us to value the known, present over the probable future, leading to the exact herd behavior that allows sophisticated investors to buy the future at a discount. Think of it like a massive ancient forest. For decades, you have been walking past giant old oak trees. These are the traditional health services, the massive gym chains, and the established pharmaceutical giants. They look permanent and indestructible, but suddenly a massive storm rolls in. The wind starts ripping the leaves off these giants, and some are even getting struck by lightning. To a child standing in the forest, it looks like the world is ending. They see the branches falling and they run away in fear. But if you look down at the forest floor, you will see something incredible. The rainwater from the storm is feeding thousands of tiny, vibrant saplings that were waiting for this exact moment. These saplings are the biotech startups and the AI innovators. They need the canopy to thin out so they can finally reach the sunlight. The child only sees the destruction of the old, but the gardener sees the birth of the new. Right now, most investors are acting like the scared child, while the smart money is acting like the gardener, planting seeds in the areas where the old giants are failing to provide cover. Moving deeper into the mechanics of this shift, we must address the silent architect of this new era, which is the integration of artificial intelligence into pharmaceutical, manufacturing, and drug development. We are seeing companies like Bristol-Myers Squibb building pioneering plants that leverage AI to streamline production in ways that were considered science fiction only 5 years ago. This is not just about making things faster. It is about fundamentally changing the cost structure of human health. To understand the magnitude of this technological leap, we can look at the historical parallel of the Industrial Revolution. In the late 18th century, before the steam engine and the power loom, everything was handcrafted. Production was slow, expensive, and prone to human error. When James Watt refined the steam engine, he didn't just make a better pump. He unlocked a new dimension of human productivity. Suddenly, what took 1,000 men a year to produce could be done by a dozen machines in a week. AI in the pharmaceutical sector is the steam engine of the 21st century. For decades, drug discovery has been an artisanal process. Scientists would manually test thousands of compounds, hoping for a breakthrough. It was expensive, slow, and had a massive failure rate. Now AI can simulate those millions of tests in a digital environment before a single vial is even opened in a lab. We are moving from the handcrafted era of medicine to the industrial era of medicine, just as the steam engine created the first global middle class by making goods affordable. AI-driven pharma has the potential to solve rare diseases that were previously ignored because they were too expensive to research. We are at the dawn of a new productivity frontier that will make the previous century of medical progress look like the Dark Ages. The psychological reason we struggle to price this innovation correctly is due to our inherent discomfort with exponential growth. The human brain is linear. We expect tomorrow to look like a slightly better version of today. But technology, especially when driven by AI, is exponential. This creates a psychological gap known as the exponential growth bias. We underestimate how quickly things can change. When we see a company using AI to build a new factory, we think of it as a small efficiency gain. In reality, it is a structural shift that could render every traditional competitor obsolete within a decade. Because we cannot intuitively grasp the speed of this change, we stay anchored to old valuations and old business models. This cognitive dissonance creates a massive opportunity for those who can force themselves to think in curves rather than straight lines. We are afraid of what we cannot predict, and since we cannot predict the ceiling of AI, the herd often chooses to ignore it until it is too late. If you want to explain this to a fifth grader, imagine you have a giant puzzle with 10 million pieces. For a long time, the only way to solve it was to have 1,000 people sit in a room and try to fit each piece one by one. It took forever. It cost a lot of money to feed all those people, and they made a lot of mistakes. Now imagine you have a magic camera. You just take a picture of the 10 million pieces, and the camera instantly tells you exactly where every single piece goes. That magic camera is AI. The puzzle is a new medicine that can cure a rare disease. Before the camera, it was too hard and too expensive to even try to solve the puzzle. But now that we have the camera, we can solve thousands of puzzles at the same time. The companies that own the camera are going to change the world, while the people still trying to fit the pieces by hand are going to be left behind. But the road to this medical utopia is not without its thorns. We must navigate a systemic risk heat map that is glowing red in the area of regulatory and policy impact. From the Supreme Court's rulings on healthcare access to the CDC's changing requirements for workplace safety, the landscape is in constant flux. This creates a dynamic and often unpredictable policy environment that can destroy a business model overnight. This regulatory uncertainty has a direct historical parallel. In the early days of the Food and Drug Administration in the United States, specifically around the Pure Food and Drug Act of 1906, before this time, the health market was a wild west of snake oil, salesmen, and unregulated concoctions. When the government finally stepped in to impose standards, many of the most profitable companies of that era went bankrupt almost instantly. They couldn't adapt to the new reality of transparency and safety. However, the companies that embraced the new regulations and used them as a gold standard for quality became the pharmaceutical titans we know today. We are in a similar period of regulatory refounding. The rules of the game for data privacy, drug pricing, and telehealth are being rewritten in real time. Just as in 1906, the companies that are fighting the change are at risk of extinction. while those that are building their business, models around these new guardrails will inherit the market. The friction we see today is not just noise. It is the sound of the gates of the industry, being narrowed to let only the most robust players through. Psychologically, this creates a state of chronic stress for both investors and industry leaders. We have a fundamental need for certainty and control. This is why regulatory risk is often rated as more terrifying than market risk. Market risk is a gamble we feel we can win, but regulatory risk feels like an arbitrary hand of God, reaching down to change the rules mid-game. This triggers a phenomenon called policy uncertainty aversion. When the rules are unclear, the human brain tends to freeze. We stop investing, we stop innovating, and we wait for clarity. This is why you see such a disparity in the market right now. The retail herd is frozen, waiting for the government to tell them what the future looks like. But the titans, the sophisticated capital, they understand that uncertainty is the only time you can get a true bargain. They don't wait for the rules to be finalized. They bet on the companies that are most adaptable to any version of the future. Imagine you are playing a game of soccer, but the referee keeps changing the rules every 10 minutes. At first you can use your hands, then you can't. Then the goal gets smaller, then it gets bigger. Most players would get frustrated and walk off the field. They would say the game is unfair and impossible to win. But imagine there is one player who is so fast and so skilled that it doesn't matter what the rules are. If the goal gets smaller, they just kick more accurately. If they can't use their hands, they use their head. That player is an adaptable business model. The referee is the government. Right now, the government is changing the rules of healthcare very fast. Most companies are getting frustrated and quitting, but the ones that are fast enough to change their strategy, every time the whistle blows, are the ones that are going to win the trophy. Now we must look at the Titans playbook. How is the smart money actually moving? We see that nearly a third of all family office deals in April were targeted at healthcare startups. This is a massive concentration of wealth. These family offices are the private investment, firms of the world's wealthiest individuals. They are not looking for a quick flip. They are looking for generational wealth. They are focusing on the generational bargain, a moment where short-term fear creates long-term value. To find a historical parallel for this, we must look at the Medici family during the Italian Renaissance. The Medicis didn't just become wealthy through traditional banking. They were among the first to realize that the real power lay in funding the startups of their time, which were the explorers, the scientists, and the artists who were redefining the world. By funneling their capital into the most innovative and disruptive minds of the era, they didn't just make money. They shaped the entire course of Western civilization. Today's family offices are the new Medicis. They are bypassing the traditional stock markets, which they see as too volatile and headline-driven, and going straight to the source of innovation. They are funding the people who are trying to cure cancer, MAPI, the human brain, and integrate AI into our biology. They understand that while a gym stock might go up or down 10% in a day, the person who discovers a way to reverse aging will own the future. This is a return to the era of patron-driven innovation, where long-term conviction beats short-term speculation every single time. The psychological root of this contrarian move is the ability to overcome social proof. Most humans are social animals. We feel safe when we are doing what everyone else is doing. If everyone is selling, we want to sell. This is the herd instinct that kept us alive on the savannah. If you saw the rest of your tribe running away, you didn't stop to ask why. You just ran. But in the world of high finance, this instinct is a liability. The titans of industry have developed a psychological, thick skin that allows them to move in the opposite direction of the tribe. This is known as contrarianism, but it is more than just being stubborn. It is a deep-seated confidence in one's own analysis over the collective noise. It requires a high degree of emotional intelligence to sit calmly while the headlines are screaming that the world is ending, and instead of selling, you write a check for another $50 million into a biotech startup. It is the ultimate test of human willpower over biological instinct. Think of it like a giant sale at your favorite store. Everyone is standing outside the store, and suddenly someone screams that there is a fire inside. Everyone panics and starts running away from the building. But you look through the window and you see that there is no fire. It's just a smoke machine that someone turned on by mistake. While everyone else is running down the street, you walk calmly into the store. Because everyone else left, you have the entire store to yourself. You can buy anything you want at a 90% discount. The family offices are the people who realize the fire is just a smoke machine. The smoke is the scary headlines and the temporary stock drops. The store is the healthcare market, full of incredible inventions that are currently on sale, because everyone else is too scared to walk inside. Finally, we must discuss the survival blueprint. How do you, as an investor or an observer, navigate this? The key is a 60-30-10 asset allocation. 60% in diversified stocks, 30% in safe assets, and 10% in cash for those tactical pullbacks. We look at ETFs like XBI for biotech and EDOC for digital health. This is about prioritizing long-term innovation and resilient R&D pipelines over companies that are merely chasing the latest fitness trend. The historical parallel for this long-term R&D focus is the Manhattan Project. This was a monumental effort that required years of secret research, massive amounts of capital, and the brightest minds in the world. There were no immediate dividends. There were no quarterly earnings reports. It was a singular, focused pursuit of a breakthrough that would change history. The biotech sector today is a collection of thousands of mini-Manhattan projects. Each one is a high-risk, high-reward bet on a fundamental scientific breakthrough. When the project finally succeeds, the impact is so massive that it renders all previous efforts obsolete. This is why we must have a long-term horizon. If you had tried to trade the Manhattan Project based on weekly news, you would have failed. But if you understood the scale of the goal, you would have known that the only thing that mattered was the final result. The healthcare of the future is being built in these long-term labs of innovation, and survival depends on having the patience to see them through to completion. Psychologically, this requires us to embrace the concept of delayed gratification. We live in a world of instant feedback. We want our likes, our comments, and our stock gains immediately. But true wealth and true progress are slow. The marshmallow test is a famous psychological experiment, where a child is given one marshmallow and told that if they can wait 15 minutes without eating it, they will get a second one. The children who can wait are the ones who tend to be more successful later in life. Investing in the health sector right now is the ultimate marshmallow test. The market is dangling small, immediate losses in front of you, trying to get you to react. But if you can wait, if you can look past the current volatility and focus on the incredible medical breakthroughs that are 5 or 10 years away, you will be rewarded with the second marshmallow. This is the hardest psychological hurdle to clear, because it goes against our modern culture of now, but it is the only way to win in a sector as complex as healthcare. Imagine you are planting a fruit tree in your backyard. You dig the hole, you put in the seed, and you water it. The next day, you go outside and there is no fruit. You get angry and you want to dig up the seed and throw it away. You think you've been cheated, but your neighbor, who is a wise old gardener, tells you to be patient. He tells you that for the first few years, the tree is growing its roots deep into the ground where you can't see them. If the tree doesn't grow deep roots first, it will fall over as soon as a storm hits. But if you wait and keep watering it, one day, that tree will grow so much fruit that you won't even know what to do with it all. The healthcare sector is that tree. Right now, it is growing its roots through AI and deep R&D. It might not look like much is happening from the outside, and the weather might be bad. But if you keep tending to your investment, the harvest will be bigger than anything you can imagine. In a sector as vital as health, true value emerges, not from fleeting speculation, but from the relentless pursuit of solutions to fundamental human needs, a pursuit that consistently rewards patience and strategic investment. Historically, the healthcare sector has proven remarkably resilient and consistently innovative, navigating countless cycles of economic downturns, regulatory shifts, and technological revolutions. From the discovery of antibiotics in the mid-20th century to the mapping of the human genome, each era has presented unique challenges and profound opportunities, demonstrating the sector's enduring capacity for growth and its fundamental importance to global well-being. We couldn't fit all the deep dive details and practical strategies into this video. Check out the Warm Insight newsletter. In the pinned comment and description for the full text summary,